There is a form on the IRS website that costs nothing to download, nothing to file, and nothing to process. It is 2 pages long. It requires your business name, your EIN, and your signature. And once the IRS approves it, which in most cases takes 60 to 75 days, it can save a small business owner $10,000, $20,000, even $50,000 per year in taxes that they are currently paying and do not need to. The form does not change what your business does. It does not change how much you earn. It changes how the IRS classifies your earnings. And that single reclassification redirects thousands of dollars from the government's pocket back into yours, legally, permanently, and retroactively to the beginning of the tax year in which it is filed. The form is IRS Form 2553. The election it triggers is called the S Corporation election, and the tax it eliminates is the self-employment tax, a 15.3% surcharge that every sole proprietor and LLC owner in America pays on every dollar of profit, a tax that S Corporation owners pay on only a fraction of theirs. The self-employment tax generates over $400 billion in annual revenue for the federal government. It funds Social Security and Medicare. It is calculated on top of your income tax. And for millions of small business owners, it is the single largest tax they pay without knowing they had a choice. Welcome to the Invisible Ledger. If these stories matter to you, hit subscribe and the bell. This is where we trace the money they told you not to follow. The self-employment tax was established under the Self-Employment Contributions Act, SECA, codified in Internal Revenue Code sections 1401 through 1403. It mirrors the Federal Insurance Contributions Act, FECA, which splits payroll taxes between employers and employees. If you work for a company, your employer pays 7.65%, and you pay 7.65%, for a combined 15.3% on wages up to the Social Security wage base, which in 2024 is $168,600. The Medicare portion of 2.9% has no wage cap. When you're self-employed, you're both the employer and the employee. You pay both halves, the full 15.3%. On a sole proprietorship or single-member LLC earning $150,000 in net profit, the self-employment tax alone is approximately $21,160. That is before a single dollar of income tax, before state tax, before any other obligation. $21,000 paid simply because of how the IRS classifies your earnings. The S Corporation election changes this classification. When you elect S Corp status by filing Form 2553, your LLC or corporation is taxed under Subchapter S of the Internal Revenue Code, Sections 1361 through 1379. As an S Corp, you're required to pay yourself a reasonable salary as a W-2 employee of your own company. On that salary, you pay the full 15.3% in FICA taxes, split between the employer and employee portions. But any profit above and beyond your reasonable salary is distributed to you as a shareholder distribution, not as wages. And shareholder distributions from an S corporation are not subject to self-employment tax or FICA. Let me make this concrete. You own an LLC that earns $150,000 in net profit. Without the S Corp election, all $150,000 is subject to self-employment tax. Your SE tax is approximately $21,160. Now you elect S Corp status and pay yourself a reasonable salary of $60,000. The FICA tax on $60,000 is approximately $9,180, split between employer and employee portions that you effectively both pay. The remaining $90,000 is distributed to you as a shareholder distribution. Self-employment tax on that $90,000 is zero. You have just saved approximately $11,980 every single year by filing a form that costs nothing. The concept is not new. Subchapter S was added to the Internal Revenue Code by the Technical Amendments Act of 1958, signed by President Eisenhower. It was specifically designed to allow small businesses to enjoy the liability protection of a corporation while being taxed like a partnership, avoiding the double taxation that C corporations face. Over the decades, Congress refined the rules, and the S Corp became one of the most popular business structures in America. According to the IRS Statistics of Income Division, there are over 5 million S corporation returns filed annually. The structure is used by everyone from one-person consulting firms to family businesses generating tens of millions in revenue. Before I go further, this video is just the surface. Inside the Invisible Ledger Vault, you will find the complete S Corp election guide, Form 2553 walkthrough with annotation, reasonable salary calculation methods, payroll setup instructions, and a comparison calculator showing exact savings at different income levels. The link is in the description, but stay right here. The IRS is aware that some business owners abuse this structure by paying themselves an artificially low salary to minimize FICA taxes. This is the single biggest risk of the S Corp strategy, and the IRS has litigated it aggressively. In the landmark case Watson v. United States in 2012, the Eighth Circuit Court of Appeals upheld a district court ruling against an accountant who ran his entire practice through an S-corp and paid himself a salary of just $24,000 per year while distributing over $200,000 in shareholder distributions. The court ruled that his salary was unreasonably low and reclassified a portion of his distributions as wages, subjecting them to FICA. The IRS does not define a specific formula for reasonable compensation, but it considers factors including the nature of the services you provide, your experience and training, comparable salaries for similar positions in your industry and geographic area, the time you devote to the business, and the company's revenue and profitability. Industry benchmarks, Bureau of Labor Statistics data, and salary surveys from sources like Robert Half, Glassdoor, and PayScale can all be used to establish a defensible salary. The general guidance among tax professionals is that your salary should represent approximately 40 to 60% of your net business income for a single owner service-based business. The exact percentage varies by industry, revenue level, and individual circumstances, but the principle is clear. You must pay yourself a real salary. The savings come from the spread between that salary and your total profit, not from eliminating your salary entirely. If you have made it this far, you already understand a tax structure that saves millions of small business owners thousands of dollars per year. Subscribe and share this video. Now let me give you the exact steps. Step 1. Confirm your business structure. To elect S-corp status, you must operate as a corporation, an LLC, or another eligible entity. Sole proprietorships cannot elect S-corp status directly, but can first form an LLC and then make the election. Step 2. Download IRS Form 2553 from IRS, GovDors. The form requires your business name, EIN, date of incorporation or organization, and the tax year for which the election is effective. All shareholders must sign the form. Step 3. File Form 2553 with the IRS. The deadline for the election to be effective for the current tax year is no later than 2 months and 15 days after the beginning of the tax year. For a calendar year business, that means March 15th. If you miss this deadline, you can file with a reasonable cost statement, and the IRS may still grant late election relief. Step 4. Set up payroll. As an S-corp, you must run payroll for yourself. This requires withholding federal and state income taxes, Social Security, and Medicare from your salary payments. Services like Gusto, ADP, or QuickBooks Payroll can automate this for as little as $40 to $80 per month. Step 5. Pay yourself a reasonable salary throughout the year via regular payroll. Step 6. At year-end, distribute remaining profits as shareholder distributions. These are reported on Schedule K-1, not on a W-2, and are not subject to FICA or self-employment tax. The total cost to implement this strategy includes $0 for the form itself, payroll service fees of approximately $500 to $1,000 per year, and potentially higher accounting costs since S-corp returns, Form 1120S, are more complex than Schedule C. In total, the implementation cost ranges from $1,000 to $3,000 per year. The savings at $150,000 in profit are approximately $12,000 per year. The break-even point where S-corp savings exceed the added costs is generally around $40,000 to $50,000 in net annual profit. I need to be honest with you. The S-corp election is not right for every business. First, if your net profit is below $40,000, the added costs of payroll processing, more complex tax returns, and potential state-level fees may exceed the FICA savings. Second, paying yourself a salary reduces your ability to contribute to certain retirement plans. However, S-corp owners can still contribute to SEP IRAs, simple IRAs, and solo 401k plans based on their W-2 salary. Third, some states impose additional taxes or fees on S-corporations. California charges an annual minimum franchise tax of $800 regardless of income. New York City does not recognize S-corp status and taxes S-corps as C-corp at the city level. Fourth, the reasonable compensation requirement means you cannot simply minimize your salary to a token amount. The IRS can and does reclassify distributions as wages when salaries are unreasonably low. And fifth, the administrative burden is real. You must run payroll, file quarterly payroll tax returns, issue W-2s, file Form 1120S, and maintain corporate formalities. If you are not prepared for this level of bookkeeping, the structure may create more headaches than it solves. Your grandparents ran businesses out of their homes, off their land, out of their trucks. They paid what they owed and kept what they earned. The tax code was simpler then, but the principle was the same. You should only pay what the law requires, and not a dollar more. Then one generation was told that taxes were inevitable, that the rate on the form was the rate you paid, and that questioning the structure was something only rich people did. It is not. It is something informed people do. And a 2-page form that costs nothing to file is the difference between paying the maximum and paying what is fair. There was not a higher tax because the work was worth less. There was a higher tax because you never filed the form. Subscribe and share this video. Every share puts Form 2553 in the hands of a business owner who is overpaying right now. The next vault opens soon, and what is inside involves a 7-year rule that debt collectors pray you never discover, one that can destroy their entire case with a single calendar date.